It wasn't a glitch in the high-frequency trading algorithms. It wasn't a sudden collapse in industrial demand for electronics or solar panels. It wasn't even a standard correction within a secular bull market. It was the inevitable mathematical result of a monetary system that has severed all ties with physical reality. The arithmetic is merciless. When you build a financial structure on infinite leverage, backed by finite collateral, the only possible outcome is a liquidation event that wipes out the unprepared. The pattern is unmistakable. We are witnessing the terminal phase of a cycle that has destroyed wealth on a continental scale for 2,000 years. Current data suggest we are approaching a flashpoint where the paper price of silver and the physical reality of silver will violently decouple. This is not a conspiracy theory. This is a documented historical sequence. The incentives are clear, the mechanism is mechanical, and the precedent is absolute throughout history. Empires have faced a critical choice when their obligations exceed their resources. They can default honestly or they can default dishonestly through currency debasement and market manipulation. They always choose the latter too. Understand why trillions in paper wealth are about to vanish and why silver's historic crash is actually a prelude to a chaotic repricing. We must look at the three specific times this exact scenario played out. Before the names of the currencies change. The technology of the trade changes, but the behavior of the central planners never changes. Our first case study takes us to the archetype of all monetary collapses. The Roman Empire, specifically the crisis spanning from the reign of Nero to the 3rd century. This is the foundational example of how a state uses the silver content of its currency to delay an inevitable bankruptcy. In the 1st century AD, the Roman economy functioned on the silver denarius. This coin was the envy of the ancient world. It was nearly pure, containing roughly 4.5 grams of silver. It was the standard by which a soldier was paid and a merchant was settled. But the fiscal constraints of the empire were growing. The cost of maintaining legions on the frontier, the cost of the dole in Rome, and the cost of imperial vanity projects exceeded the tax revenue collected from the provinces. The incentive for the Emperor Nero in 64 AD was simple. He could raise taxes and risk a revolt, or he could alter the chemistry of the money. He chose the chemistry. Nero reduced the silver content of the denarius to roughly 90%. To the average citizen, the coin looked the same. It weighed roughly the same, but the intrinsic value had been stolen. This was the first step in a centuries-long crash. By the time of Emperor Septimius Severus in the early 3rd century, the silver content had plummeted to 50%. The mints were now mixing in copper, a base metal, to stretch the supply. Think about the mechanics of this fraud. The state would recall pure silver coins through taxes, melt them down, mix in base metals, and reissue 2 coins for every one they collected. They doubled the money supply, but they did not double the wealth. They simply have the value of every hour worked by a Roman citizen. By roughly 270 AD under the Emperor Aurelian, the denarius was a ghost. It contained barely 5% silver. It was a copper slug washed in a thin coat of silver that would rub off after a few weeks of circulation. The market reaction was not immediate, but it was ferocious. Merchants realized they were trading wheat oil and labor for worthless copper. Prices exploded. The state attempted to control this volatility. In 301 AD, Emperor Diocletian issued the Edict on Maximum Prices. This was a command economy attempt to fix the price of every good and service, from the cost of a haircut to the price of a bushel of rye. The penalty for violating the price controls was death, yet the inflation continued. The risk of death was less terrifying than the certainty of poverty. The economy ceased to function. Trade collapsed because no one would exchange real goods for fake silver. The middle class was wiped out, their savings in denarii reduced to zero purchasing power. The only survivors were those who had exited the currency system entirely and held physical land, gold, or pre-debasement silver hidden from the authorities. A Roman soldier in the 3rd century found that his salary, which once bought a farm after 20 years of service, could barely buy a few months of rations. The crash of the currency was total. Just like the Roman Empire, the Spanish Empire in the 16th and 17th centuries faced a similar crisis of valuation, but with a unique twist that mirrors our modern problem with supply. This is known to economic historians as the price revolution. Following the discovery of the New World, Spain stumbled upon the greatest silver deposits the world had ever seen, specifically the mountain of Potosi in modern-day Bolivia in 1545. The Spanish crown believed they had solved the problem of finance forever. They implemented the mercury amalgamation process, a technological breakthrough that allowed them to extract silver at an industrial scale previously unimaginable. Galleon after galleon crossed the Atlantic, flooding Seville with tons of silver. The King of Spain, Philip II, used this influx to finance wars across Europe. He believed silver was wealth. He was wrong. Silver is money, but money is only a claim on goods. If you increase the supply of money without increasing the supply of goods, you crash the value of the money. This was a supply-side crash of silver's purchasing power because the Spanish crown used this silver to pay for armies and interest on debts. The money entered the general economy rapidly. The result was catastrophic inflation. Between 1500 and 1600, the price of grain in some parts of Europe rose by 400% or more. A shoemaker in Castile found that even though he had more silver coins in his pocket than his grandfather ever did, he could buy less food. The abundance of silver actually impoverished the population because the velocity of the money destroyed the price mechanism. But here is the key mechanism that connects to modern manipulation. Despite this massive influx of physical silver, the Spanish crown went bankrupt. Philip II defaulted on the state debt in 1557, 1575, and 1596. How does the owner of the world's largest silver mine go bankrupt 3 times? Because they leveraged their future production. They borrowed from banking families like the Fuggers and the Genoese, promising future silver shipments as collateral. They spent the silver before it was even mined. When a storm delayed a fleet, or when the yield from the mines dipped, the leverage imploded. The crash was not just in the value of the currency, but in the sovereign credit of the empire. The Spanish economy was hollowed out, industry withered because it was easier to import goods with New World silver than to manufacture them at home. When the silver flows eventually slowed, Spain was left with no industry, a crashed currency, and a population that had forgotten how to produce. The empire collapsed under the weight of its own monetary illusion. Just like the Spanish Empire, the British Empire in the 20th century, and specifically the Weimar Republic in Germany, shows us the final stage of this pattern, the total abandonment of the metal anchor. We turn our attention to Germany between 1914 and 1923. This is the most documented case of a paper crash in history, and it serves as the ultimate warning for the modern era. Prior to World War I, the German mark was backed by gold and silver. It was a stable store of value. A family could save for a generation and know that their savings would hold purchasing power. When the war began in 1914, the German government suspended the convertibility of the currency. They needed to print money to pay for the war, and the constraints of a metallic standard were inconvenient. They believed they would win the war and pay off the debt with the spoils of victory they lost. By 1919, the new Weimar Republic was saddled with crushing war reparations denominated in gold marks or foreign currency. They could not print gold. They could only print paper. The industrial output of the Ruhr Valley was seized by the French. The government's response was to print paper marks to pay striking workers and to buy foreign currency to pay reparations. The arithmetic was suicidal. In early 1922, the exchange rate was roughly 320 marks to $1. By late 1922, it was 7,400 marks to the dollar. By November 1923, it was 42 trillion marks to the dollar. But let's look away from the astronomical numbers and look at the human reality. The price of silver and gold did not change. The value of the paper collapsed against them. People who held their wealth in government bonds or bank savings were wiped out completely. A lifetime of savings could not buy a cup of coffee. However, those who understood the difference between paper promises and physical reality survived the flight into hard assets or asterisk. Flucked and disatward asterisk became a mania. Farmers refused to sell eggs for paper money. They would only trade for silver cutlery, gold rings, or tools. Pianos and antique furniture were traded for sacks of potatoes.
The middle-class teachers, clerks, pensioners were destitute, but the speculators who had borrowed massive amounts of paper marks to buy real assets like silver, land, and factories became the new elite. They paid off their debts with worthless paper. The crash was a transfer of wealth from the prudent saver to the leveraged speculator and the holder of hard assets. The silver price in paper marks went to infinity, but that wasn't a gain. It was merely the reflection of the paper dying. The lesson from Weimar is that when the confidence in the state dissolves, The price of the metal is no longer a chart. It is a survival mechanism. The pattern repeats in 7 distinct stages. Stage 1 is sound money. The currency is defined by a weight of precious metal, or a rigid peg. Trust is high, inflation is low, and the economy grows based on productivity and savings. This is the era of the Roman Republic, or the classical gold standard. Stage 2 is overreach. The state expands its commitments beyond its ability to tax. This can be due to war, as in the case of Spain and Britain, or social programs and bureaucracy, as in Rome. The budget deficit becomes a structural feature, not a bug. Stage 3 is the shortcut. The government realizes it cannot raise taxes without causing political instability. It chooses the path of least resistance. Debasement. In the ancient world, this meant melting coins. In the modern world, it means expanding the central bank balance sheet and suppressing interest rates. Stage 4 is asset inflation. The newly created currency does not flow immediately into bread and milk. It flows into financial assets. The stock market rises, real estate booms, and the bond market rallies. This creates a wealth effect. The elite feel rich, and the politicians claim the economy is strong. This is the false boom. Stage 5 is real inflation. The velocity of money picks up. The currency begins to leak from the financial sector into the real economy. Prices for everyday goods begin to rise. The state blames supply chains, greedy corporations, or speculators. They deny the monetary origin of the problem. Stage 6 is the crash and the wipeout. This is the critical phase we are analyzing. Volatility explodes. The central bank is trapped. If they stop printing, the asset bubbles collapse. If they keep printing, the currency collapses. Often they try to manipulate the price of safety valves like silver and gold to hide the erosion of the currency. This leads to a massive disconnect between the paper price and the physical price. Stage 7 is the reset. The system becomes mathematically broken. A new currency is issued, often with a hard anchor or a revaluation of gold and silver reserves to restore confidence. The old paper wealth is deleted. Just like in Rome, Spain, and Weimar, current data suggest we are deep into the later stages of this sequence. We are witnessing the specific dynamics of Stage 6, the volatility and the disconnect. The title of our analysis refers to the trillions of dollars in paper derivatives that currently suppress the price of physical silver. The mechanism is known as the paper-to-physical ratio. In modern markets, for every ounce of physical silver sitting in a vault, there are estimates of hundreds of ounces of paper silver, traded on exchanges like the COMEX and the LBMA. These are futures contracts, unallocated accounts, and ETFs that claim to represent silver, but are often settled in cash. This is the modern equivalent of the Roman emperor mixing copper into the denarius. It creates the illusion of supply. It allows large financial institutions to sell massive amounts of non-existent silver to drive down the price when it threatens to break out. This is not speculation. It is a structural feature of the market. Regulators have fined major banks hundreds of millions of dollars for spoofing and manipulating precious metals markets. The incentive is to maintain confidence in the fiat currency. If silver were to rise to its true inflation-adjusted value, it would signal a collapse in the confidence in the dollar and the euro. Therefore, the price is managed. But the arithmetic of 2026 suggests this management is reaching a breaking point. The physical market is in a structural deficit. Industrial demand for silver in photovoltaics, electric vehicles, and electronics is stripping the mines dry. Above-ground stockpiles are draining. We are approaching a moment where the industrial user, the company that needs actual silver to build a solar panel, cannot source it at the paper price. When that happens, the paper market breaks. The shorts, those who have sold silver they don't have, will be forced to cover, but there is no physical metal to buy. This sets up a short squeeze of historic proportions. The crash will not be in the value of silver. The crash will be in the value of the paper contracts. Holders of paper silver will likely be settled in cash at a capped price, while the physical metal becomes unobtainable at any price. This is the wipeout. Trillions in paper claims will evaporate because the collateral simply isn't there. One interpretation is that the central banks will manage a smooth transition, slowly allowing silver to rise to ease the pressure. However, history argues against this. The incentive structure prevents a slow release. A slow rise invites speculation. The authorities will likely fight the rise until the dam breaks. This leads us to the three possible endgames. The first endgame is controlled decline. This is the financial repression scenario. Inflation runs hot, perhaps at 5 to 10% annually for a decade. Silver prices rise steadily, but are constantly capped by regulatory changes and margin hikes. The middle class has slowly boiled their savings, eroded year by year. This mirrors the post-World War II period where debts were inflated away. However, the current debt levels are far higher than in the 1940s, making this path difficult to maintain. Without losing control, the second endgame is chaotic collapse. This is the Weimar scenario. The bond market rebels, yields spike. The central bank is forced to print trillions to save the government from default. Confidence in the currency evaporates overnight. In this scenario, the paper-silver market shuts down completely, exchanges declare force majeure. The price of physical silver disconnects vertically from the official price. Commerce halts until a new medium of exchange is agreed upon. This is the most painful outcome, resulting in social unrest and a complete restructuring of the political order. The third endgame is reset and restructure. This is the most likely outcome for the 2026-2030 window. Recognizing the mathematical impossibility of the debt world powers, convene to establish a new monetary framework. This could involve a digital central bank currency, or a new basket of currencies backed partly by commodities like gold and silver. In this scenario, silver is revalued overnight to a much higher price to balance the balance sheets of the central banks. It is a one-time step function change in price. Those holding physical metal are the beneficiaries of the new system. Those holding paper currency or paper derivatives are the victims of the adjustment. We saw a version of this in 1934 when the U.S. government revalued gold from $20.67 to $3,500, effectively devaluing the dollar by 40% in a single stroke. The pattern is clear. The historical precedents are unambiguous. The leverage in the system guarantees a reckoning. The only variable is timing and pain. Subscribe to this channel to continue monitoring the data as this cycle accelerates. Prepare by educating yourself on the difference between counterparty risk and physical ownership. Focus on resilience, not speculation. Watch the deficit numbers. Watch the inventory levels at the COMEX. The history of money is a history of the same crime committed over and over again. Do not be the victim of the next repetition.